Sarah just told you we're at the highs of the session here, and we've been slowly ramping as the morning has gone on. Nasdaq's good for just shy of 1%, but the S&P and the Dow are quite good as well. Joe Wolf Research today says signs that new record highs are ahead. We are 3% roughly away on the S&P 500.
That's generally been my feeling over the last month, that we were going to push higher, make an attempt to run at all-time highs. We have that Geneva price gap from 3 weeks ago, that weekend where the market gap from 56.91 to 57.67. 58.30 is the lowest we've been since then. But we're kind of running sideways in place. Look, Steph, you've done a great job talking about the fundamentals. What I'm looking at is I look at technicals. I look at momentum. And I'm just telling you, the technicals and the momentum are way too strong right now to be stepping forth and saying, OK, we've got an inflection point coming. The market's about to roll over. In addition to that, yields have kind of calmed down. So we really don't have that worry so much anymore. You have a significant amount of S&P 500 companies that are making 52-week highs. Steph, Boeing, you got to start somewhere. 52-week high today. It's getting there. You have several other names that are making 52-week high. We'll talk about CrowdStrike later, but it's Netflix, it's Avago, it's Axon, it's all the usual suspects. And when you have that many stocks making a 52-week high, that's not indicative of a market that's about to roll over. So I think right now, literally the pain trade is probably to the upside, because I don't think sentiment reflects where price is.
Well, nobody chases sentiment and momentum either up or down like Wall Street strategists, because when things were deteriorating, you had, and I guess rightfully so at the time, you had a number of targets come down, and now that we're in a new environment and 3 or so percentage points away from an all-time high, you do have them going the other way. Deutsche Bank today says they're back at 65.50. They were at 61.50. And they're also looking at estimates on earnings higher as well, taking those from 240 to 267. So it seems like many of the most dire predictions about where this market can go have all but dissipated, not to suggest that people don't see volatility ahead or there still aren't some serious questions that need to be answered, but the tone is one of, yeah, we're probably going higher.
We should go higher. Just focus on the fundamentals. The Atlanta Fed tracker yesterday came out at 4.6% growth for the quarter. I mean, I don't think we're there, actually, but better than recession, which is what some of these negative strategists are talking about. Maybe you're running at about 2.5% kind of growth. Personal income, that number still is on my mind. That came out on Friday. It was 3 times expectations. That is good. And then consumption, if you average the last 2 months, 0.4%, that's good too, solid. But that means that savings rate is actually going higher. Today we got the JOLTS numbers up month over month. The total hirings also up month over month. And then the inflation numbers are coming down. I'm looking at the PCE. I know that the Fed looks at super core, and I know we should be looking at core to smooth things out. But overall inflation at 2.1% is very healthy. What does this mean? Why is the market going up? Because the economy is hanging in. It's better than hanging in. It's surprising people to the upside, and that bodes well for earnings overall. We just completed earnings and they grew 12.3% in the quarter. That was higher than I thought. I mean, I thought 9-10%, 12% this year. I think you can actually see 10 to 12% for the full year. That's actually better than what I thought even a couple of weeks ago.
There are still, though, those who say the worst of this trade war and the uncertainty is to come. The soft data is going to end up, and in some cases already ending up in various parts of the hard data. The OECD today said the Trump tariffs are going to sour the global outlook. They cut the forecast for U.S. growth sharply, downwardly revised to just 1.6% this year and 1.5% next year. J.P. Morgan's trading desk, Jay Snipes, says tariffs are a net negative. When does this become fully apparent in the macro data, they ask? Well, our best guess is either July or August. If we get to the point that non-farm payroll is printing materially below 100K and there is no change to the trade war rhetoric, this is a market that will crumble. Those are their words directly. Now, the big question mark is there is no change in the trade war rhetoric, that's what you're going to get. You believe that as we think about what the summer's going to hold here?
A couple of things. I think Steph makes a great point just in terms of earnings. Earnings are obviously very positive, close to 13% earnings growth. in addition to a 78% beat rate. You know, when I think about just the S&P, 27+% mega cap earnings growth rate. That's very significant. The other 493 were up around 9.4%. From a technical perspective, about 48% of the S&P is trading above the 200-day. So that was a very different number a quarter ago. So I think that's important to note. So I think that the bias is absolutely to the upside. I think the fundamental story is playing. Obviously, Steph mentions inflation. Inflation was very positive. We've been talking about that for a while. But what I will say is a theme that played out in earnings for me was the lack of guidance and some pausing of guidance, which speaks to some of the revisions downward in terms of the next couple of quarters. So I think it's going to be an interesting summer. I think we'll trade in a range, but I think the fundamentals are positive, which keeps me constructive on the market.
This idea that, you know, you've got these cracks lurking in the bond market under the surface, and, you know, at some point, as Diamond said, you know, late last week, there's going to be a crack in the bond market. You know, we saw one, as I said, we've had a tremor of sorts once already that did not develop into a full-blown quake because the White House backed off that level of tariffs on that day. And then the market certainly calmed itself. Is that still lurking? Or is the market going to doesn't seem to care at all or really want to focus on that until it absolutely has to, if it ever does have to?
No, right now the market is responding to, as Steph said, better than expected eco data, very strong earnings, strong revenue growth. In some places, maybe you had some earnings contraction related to margin compression. And yields have kind of calmed. And the market's looking at that. But I don't think that you could ignore that in the third quarter we're going to have challenges as it relates to issuance. And it's not just issuance here in the United States. It's going to be global issuance. And it's going to be difficult, I think, for global bond markets to digest that properly. So if there's going to be a period of consternation on this journey, you know, through 2025, I think it's ultimately going to be in the third quarter. You've heard me say, I think we pushed to all-time highs. I'm not of the belief that we break out significantly above those highs in the near term, in the third quarter, because to your point, there's going to be issuance challenges. There's going to be bond market contention that I think has to be wrestled with. I don't think we're done pressing a 30-year yield towards 5.25. I don't think we're done with the conversation that a 10-year yield could go to 5% as well.
Don't you think, though, that yields are going higher because the growth is actually better than expected?
I mean,
I understand the debt concern.
Yeah.
I do. I really do. But that's not new, Joe. You know?
I think it's a combination of both. I do. I think it's a combination of both. I also think we have to see where this bill lands, where ultimately, what does the bill look like in terms of spending, and what's the effect on deficits.
See what happens. I think, to Joe's point, I mean, I do feel like that is alive and well in the market, that yields are elevated more so. Look,
it's an issuance.
Nobody knows the exact reason, okay?
Right.
And I'm not going to pretend that I do either. Right. But I talked to a number of people who are watching what's happening within the bond market and are fixated on where the deficit is. Not that those concerns are new, but that there's no wherewithal to do anything about it. And all we do is deficit spend and deficit spend and deficit spend. And now we're talking about a $4 trillion bill that Congress doesn't really want to deal with the deficit in any way. It's a kick the can down the road until the can gets run over by a truck.
For sure. And I have said for a long time, unfortunately, we are going to kick the can, and it's going to be our children that actually have to deal with this, not us, because no one in office or in Congress has any wherewithal to get anything substantially done.